Netflix stock is facing a major test in 2026. Can advertising growth replace the fading boost from password sharing?
That is exactly the multi-billion-dollar question we are breaking down today.
Okay, let's dive into this. Engine 1, the Q2 2026 earnings reality. When we look at the actual numbers, we're seeing a fundamentally solid quarter for the streaming giant. Revenue hit a massive $12.56 billion. That's up 13% year over year. Their operating margin came in at a very healthy 33.4%, bringing in about $3.4 billion in net income. But really, look at that bottom line right there, $1.53 billion in free cash flow. Now, if you're newer to financial analysis, free cash flow is basically just the cash a company generates after paying for all the cash outflows needed to run its operations and maintain its assets. It is the leftover money that gives Netflix the total flexibility to fund heavy new content slates, invest in ad tech, or return capital to shareholders. Financially speaking, they are generating a massive amount of cash.
So, if the quarter was that solid, why did the stock face a sharp sell-off in July? Well, the answer lies right here. $51 to $51.4 billion. That is management's narrowed full-year 2026 revenue guidance. The stock market is fiercely forward-looking, right? And at Netflix's current scale, shifting from mid-teens percentage growth down toward low-teens growth makes investors incredibly nervous. This narrower guidance sparked immediate fears of a growth deceleration. Investors aren't just looking for good historical profit numbers, they want absolute assurance that the growth engine isn't stalling out on them.
And that brings us to our next catalyst. Password sharing reaches maturity.
This maps out what is arguably one of the most successful monetization experiments in streaming history. Back in 2022, Netflix identified a massive opportunity. Over 100 million households were using accounts paid for by someone outside their home. So in 2023, they executed a broad paid sharing rollout, and it immediately resulted in an incredible 5.9 million membership acceleration in Q2 of that year alone. It was a massive windfall. But as we sit here in 2026, we are squarely in a period of monetization maturity and a baseline reset. The largest conversion gains, they've already happened. It successfully and permanently raised the revenue baseline, but it's just no longer an easy, tappable source of incremental subscriber growth. The biggest boost is simply behind them.
If you're enjoying this analysis, make sure to subscribe, like, and share Fox of Wall Street for more stock market breakdowns.
Now let's pivot to the really vital part of this story. Engine 2, the advertising growth engine. This is where Netflix is transforming into a two-engine subscription and advertising behemoth.
To see exactly how fast this transformation is happening on the ground, check out this adoption rate. In early 2026, in the markets where the ad tier is actually available, over 60% of new signups chose that specific ad-supported plan. I mean, that is a huge shift in consumer preference. It proves that viewers are highly receptive to trading just a bit of their attention for a lower monthly price point. And it gives Netflix the amazing ability to monetize the exact same viewing session twice, once through the subscription fee and again through advertising.
And all that rapid adoption leads us directly to this staggering figure, more than 250 million. By May of 2026, Netflix reported that its ad-supported tier had reached over 250 million global monthly active viewers. Now, it's incredibly important to clarify something here so we're all perfectly clear on the math. This massive figure represents a measure of audience reach based on people viewing ads and estimated household viewing. It is not equivalent to 250 million individual paid ad tier subscription accounts, but as a reach metric, it proves Netflix has successfully built a global audience scale that major advertisers simply cannot ignore.
So how does that massive audience reach translate to actual dollars? Well, Netflix expects its advertising revenue to literally double, jumping from about $1.5 billion in 2025 to a target of roughly $3 billion in 2026. This rapid financial growth is being fueled by a huge influx of ad buyers. The company has seen a 70% year-over-year increase in its advertiser base, which now totals over 4,000 buyers. Advertisers are just flocking to the platform to get their products in front of those 250 million active viewers.
Okay, so how does this machine actually operate? It's called the Netflix ad flywheel. Step 1, you need the signups and the viewers. Step 2, you need those users to actually watch the content, generating viewing hours. Step 3, those hours create valuable ad impressions. And Step 4, those impressions are sold to generate advertising revenue. Here's the catch. If Step 2, the viewing hour, stalls out, the entire flywheel breaks down. That is exactly why Netflix is pushing so aggressively into new formats like live events, partnerships, and creator-led video. They absolutely have to drive the engagement and viewing hours needed to generate those lucrative ad impressions.
Which brings us to a neutral look at the bull case versus the bear case for this stock, based directly on our two-engine framework. Looking at the bull case, optimists argue that ad revenue is scaling rapidly toward a massive, multi-year profit pool that will fundamentally change the company's valuation. They love to point out that Netflix impressively maintains operating margins above 33%, offering incredible financial flexibility. Plus, Netflix still only commands about 5% of global TV viewing, leaving a huge runway to steal market share from traditional television. On the flip side, the bear case argues that $3 billion in ad revenue is still just a mid-single-digit drop in the bucket, compared to Netflix's expected $51 billion in total 2026 revenue. To the bears, the ad tier is simply too small right now to offset the slowing growth in core subscriptions. Bears also heavily emphasize that the easy growth from the password sharing boost is permanently over, and that heavy content spending on unproven live events and new ad tech risks eating into those high margins, which could lead to stock multiple contraction.
So the crucial point is knowing what to look for next as we head into the upcoming quarters. Let's look at the key metrics. The entire investing story has shifted, guys. It is no longer, can Netflix monetize password sharing? The new question is, can Netflix monetize engagement better than its peers? So here's your rapid-fire investor scorecard for the next few quarters. First up, watch Q3 revenue growth versus their 11.7% outlook. Can they beat expectations? Second, track ad tier monetization and revenue closely to see if that $3 billion target is achievable. Third, monitor viewing hours, overall engagement, and subscriber churn rates to ensure the ad flywheel is spinning. Fourth, see if they maintain their strict discipline on operating margin versus the 31.5% full-year target. Fifth, keep an eye on that massive free cash flow generation. And finally, look for hard evidence that their new formats, like those live events and creator-led videos, are actually succeeding in driving engagement without disproportionately skyrocketing their content costs.
So we leave you with this final thought to ponder. As the easy subscriber gains of the past fade into the rearview mirror, can Netflix's emerging advertising engine truly scale fast enough to permanently sustain its massive market cap?